Welcome to the Agent of Wealth podcast with Marc Bautis from Bautis Financial. In this podcast, Marc helps guide you towards financial freedom, ensure you never run out of money, and create a balance in life that prioritizes what is most important to you. Join us for this journey as Marc draws from years of expertise and guest experts to solve the multiple wealth building challenges involved in your financial life.
Welcome back to the Agent of Wealth. This is your host, Marc Bautis. On today's show, we brought on a special guest, Elliott Holland. Elliott is a Harvard MBA alum and the founder of Guardian Due Diligence, which specializes in helping everyday people acquire businesses as investments to optimize ROI and create new millionaires. Elliott, welcome to the show.
Good to be here. Thanks for having me, Marc.
I'm excited to talk about today's topic of how to buy a business. And I think, creating new millionaires, I think people are really eyeing that, looking towards what they need to do that. And, there's different angles that someone can do.
Absolutely.
I had on a couple of recent shows, we talked about franchising. We talked about buying different asset classes, whether it's real estate or some other type of business. But we've never really gotten into the nuts and bolts of what that means or how to properly buy a business. So I'm looking forward to it.
Absolutely. It'll be great to share that with your audience.
Cool. Now, maybe get started. Tell me a little bit about Guardian, how you got, into the business of really helping people and, do proper due diligence.
Sure. And really what Guardian does is helps facilitate business acquisition for typically first-time buyers who are outside of a fund. So regular investors who are looking to do deals themselves. I called it Guardian Due Diligence because the hardest part of getting a deal done is doing the financial due diligence and making sure that the numbers are solid. I got into this somewhat of an accident. So when I finished up at HBS, I worked at two different private equity firms that were more oriented in long-term value investing and a bit more strategy than traditional financial engineering. And then I spun out and with a mentor of mine, started my own independent business buying outfit where we bought companies sort of $1 to $5 million in EBITDA, earnings before interest, tax, depreciation, amortization. During that time, I had to question, check out dozens of CPA firms that were doing due diligence. And I really didn't like the solution for smaller deals for a lot of reasons. I can get into that later. And so I started Guardian to be the service firm that I wish I had when I was buying companies, and particularly to help facilitate first-time buyers who are spending a year or two buying a company and then may spend 4 to 5 years either passively investing in or operating a business. And so the benefit to them of understanding the deal process is low. I can help with that. And then we can help them with financial diligence. And so it enables people to get deals done. That's really what my firm does.
Great. Yeah. And we'll get into that. Before we even start there, how are you seeing people find a business to buy? Because I think that it is something that's appealing now with everything going on. I think some people are out there saying, I wish I was a business owner, or even people that have businesses, existing businesses may look to expand and maybe grow, by acquiring new business. But how does someone find it? Is there like an MLS similar to real estate where businesses are listed, or do you kind of have to look out for them?
So I think for most seasoned investors, the more likely way they're going to come across a business that they feel comfortable enough investing in is through your own social networks, through, your country club, your social clubs, your group of friends, through places you go in cities or towns or your local area that are solid businesses that you may have met the owner, something of that nature. So a lot of it is informal, Marc, because a lot of it is trust-based. But to answer your question directly about MLS, there are websites like BizBuySell, BizBuySell, that are not as comprehensive as MLS, but are a place to start to find deals for sale. And they'll list companies, your local laundromat, your local car wash, to, a national long distance trucking company, to a oil and gas service company. So there are, dozens, if not more, sites like that where you can find businesses for sale. And that's where people start typically.
And what about, you mentioned those most likely for seasoned investors, but what about that person who's buying their first business, who they may not even know what type of business? Is it usually what comes first? Do they figure out, I want to be in this type of business, or do they find a business that looks good and say, well, this is the route I'm gonna take?
Well, let me answer it a bit differently, but hopefully this will be kind of what you're looking for. So let's say I'm Josh, Mr. Want to buy my first company. So I'm just starting off, right? So I have a public market portfolio. I probably have my 401k through my job. have some real estate, and I'm thinking, hey, franchises are cool, but maybe I want to go buy a business. So that's what you're sort of asking. The first thing to do is sort of realize, are you more of like an industry person, a function person, or a location person? So if it's industry and metals or chemicals or SaaS, then you want to probably anchor on that and maybe be more flexible around the function that needs to be done to grow that company or the location. You may say, hey, I'm in Manhattan and I don't want anything more than an hour drive from my front door. So you may be location specific and you may be more flexible around industry and function. And then you may be a function guy, so sales. So you're looking for a company that needs a sales boost to get to the next step. And that may be the thing you anchor on. What you would do is go to a place like Biz Buy Sell and just filter for whatever thing that you're looking for. Now, location's far easier, so is industry. In terms of function, most small businesses need sales and need process, so like an operations person. So if those are your strong suits, then almost any business is good for you. You can also meet with local business brokers. There's an International Business Broker Association, IBBA. You can go to that website and get the list of brokers in Manhattan and Philly and Boston and start calling those folks and say you're looking for a business that's $1 million in EBITDA, $5 million in revenue, 2 hours from Boston, and here's the 5 industries I'm looking for. And as you start, you won't get a lot day one. You'll get more month one. You'll get more 6 months. You'll get more 9 months. But you can start building up a funnel of deals.
And so fast forward, and let's say they find something that looks appealing to them from whatever they're looking at from that listing looks appealing.
Sure.
Where do they go next?
Sure. So to make this the simplest as possible, the offer is a letter of intent. So for those in real estate, you'll be familiar with that term. The letter of intent for a private business is typically a bit longer because there's more terms you need to iron out. But you can sort of Google for a sample template or even email a broker or a guy like me. We all have sort of templates you can use. You send the letter of intent and then you negotiate with the seller for what offer they're willing to accept for you to buy the business. Now, it may take a time or two, and then you get a seller that says, hey, I accept your letter of intent. So real estate, you may have 2 weeks for due diligence. In private businesses, you typically get 90 days plus or minus. Well, why is it so long? It's because it may take you 2 weeks to kick the tires on the business to see if you really want it. You get way more data after you have an executed letter of intent than before. It's going to take a diligence provider like myself on financial diligence about 4 weeks to get through our process. And it'll take another 2 to 4 weeks to get through the asset purchase agreement, all the documents that need to be executed for the deal. So you'll go through that sort of 3-month process. Hopefully you will know providers who can do the financial diligence or the legal diligence. If you don't know those folks, then probably before you sign an LOI, you may want to start looking for them. And I can talk about where to find them in a second. And then hopefully everything goes well. You'll never get a perfect deal. The numbers will never end up perfect the way you thought they were. The legal document will always have some pain in the butt negotiations. But if you manage through that whole process in a solid way, you'll become the owner of a solid business. And then I guess the things to talk about are finding advisors and then how to finance these deals.
One question on that. So again, we have this first-time business buyer who's maybe not necessarily really in tune of what businesses are worth. How do they put that offer together? How do they come up with something where, do they have limited information before they make an offer in terms of financials and all that? Or how do they come up with an offer that's accurate?
Most times what you'll get from a business are either tax returns and a write-up on the low end, or you'll get a 10-page to 30-page confidential information memorandum on the business. And that confidential information memorandum will have revenue, profit, operations, what the business does, all these kind of things, right? With that information in either one, the taxes or the memo, you're going to have sort of the profit that the business has done in the past year, or an average of the profit the business has done in the past 3 years. EBITDA is typically the metric that people use, but it's pretty close to profit. And so the way businesses are valued for companies under, call it $1.5 million in EBITDA, the valuation is typically 3 to 4 times EBITDA. So if you don't know where to start, just know that it's 3 to 4 times EBITDA. And don't trust me, ask your friends, ask the broker. It is a seller's market, so it may be pushing up a little bit past 4. But if you send an offer at 3.5 or 4 times EBITDA, you won't get laughed out of the negotiation. And the reasons why it would be higher or lower are really a function of how much you like the business, how much you think it can grow, and how well you'll be able to take ownership and management of it on day one.
Okay, so now again, back to the offer, it gets accepted, due diligence starts. You said it's around 90 days. Where do they go first? And you mentioned advisors and then funding. What are probably the two next steps?
Here's how to fail at finding advisors, Mark, and then people understand better how to do it right. So the CPA that does your taxes is not a good transaction CPA. They may not tell you that, but you don't want to hire a heart surgeon to do brain surgery, right? They're both very smart people. So you want to find a transaction attorney. So ask your 5 best friends if they know anybody that does transaction accounting work. If you don't have a person in your network, look on LinkedIn. If you can't do LinkedIn, look on Google. Try to find people that have ratings or find people who you have mutual connections with so you can kind of check what's going on. I say the same thing about lawyers. You're going to want to line up a transaction lawyer. You don't want the guy that does contracts on your real estate to be doing your transaction. And why would you not want to use your trusted accountant or lawyer? It's because a transaction accountant or a transaction lawyer will see the appropriate amount of risk in the transaction and know how to prioritize the things that are important and which ones aren't, and get you through a good process quicker or protect you from a bad process quicker. Whereas a person who's not trained in the specificities of small business transactions will have to sort of learn on the job and will create mountains out of molehills and miss mountains looking at molehills. So that's the best way to do it.
Anyone else you need on the team at that point, aside from, let's say, a CPA or an attorney?
Not really. At the end, you'll need an insurance broker. But if you put "I need insurance" on LinkedIn, you'll get 10 calls that day. So they're not hard to find. That doesn't mean that they're a dime a dozen. Finding a good one is a lot of value, but it tends to be something you can do quicker. And then, of course, there may be other things you need to do. So, for instance, in a manufacturing business, you have to be worried about, is the facility leaking oil into the ground? Because you may inherit that liability. So you may need somebody to go do a spot check on the earth underneath the place to make sure it's solid. But those are the main, that's 90% of the ball game, getting an accountant and an attorney.
So you just brings up a good point. You mentioned like the environmental, and is there like someone quarterbacking this whole, is the attorney the one quarterbacking this whole transaction, or the buyer? Where would that fall under?
Mark, that's a great question. Typically the buyer would quarterback. Reason being, you have to select all the advisors, pay all the advisors, tell them what you're most sensitive to, and you'll have to be in discussion with them around what you'll take and what you'll accept, right? So will you accept, only 6 months of the seller transitioning with you to teach you how to do the business, or do you need a year? That's a negotiation you're going to have with your lawyer to figure out where you fall on that. However, one of the things that Guardian does, and the reason why we focus so much on first-time buyers, is we have a done-for-you diligence service where we'll actually quarterback the deal for you and check in with you kind of once a week or as much as you'd like to go through the process. So that works really well for first-time buyers, or really well for people who have full-time jobs while they're doing this. Because if you're working a full-time 40-hour, let alone 60 or 80-hour-a-week job, you're not going to have the 30 hours or so a week to really make a good $1 million investment in a business. So you can allow a group like us to quarterback that, let you know what's going on, and go through it that way. So it'll be you or an advisor. Now, I'm not a CPA firm. I manage 21 CPAs. I'm a deal person that has come into the due diligence space. And so that's the difference in between myself and my firm and our competitors, is that we have the capacity to bring a diligence package to you, the capacity to even help you with the legal portion of the process. So for instance, we talked about Josh, first-time buyer, 5 minutes ago. If he's thinking about doing his first transaction and he's looking at, a CPA firm that does transactions, or a firm like Guardian, we can coach them through the whole process, right? And help them get a full deal done. And what that means is helping facilitate a good deal, Mark, and telling them to run for the hills if it stinks. If Josh just goes and gets a CPA firm, then he'll be managing that process himself, and he'll have to sort of learn on the job until he gets comfortable enough to make a decision.
During the due diligence period, what kind of outs does the buyer have? Can they get out for any reason, or are there specific, usually, things in there that they're allowed to get out for?
Any reason at all. Now, here's the reality of it, Mark. It's a trust walk. So the best way to describe it is like a trust walk from day 1 to day 90. So day 1, it's a seller you probably met through the internet or through a broker. You've never been to their house. You never ate meal with them. you don't even know if they're a real person with teeth, right? Day 90 to consummate a deal, you've been to their house, you've been to their town, you've walked through the business, you have financial diligence, legal diligence, you probably know where they like to do in their spare time, you probably know their kids' names. So from like day 1 to day 90, a lot of stuff happens. At any point along that process, either the buyer or the seller can back out. And so, Elliott, that sounds like a lose-lose proposition. Well, no, because here's the thing. So let's fast forward from day 1 to day 30, just to give you a sense, right? So day 30, you started financial diligence. Day 30, the seller has a broker more than likely. So if you think about what either one of you is walking away from, the buyer's walking away from probably 4 weeks to 8 weeks of time plus, $10,000 to $50,000 in financial diligence costs, right? The seller, if he walks away or she walks away, they're walking away from some sort of retainer they paid their broker, and they probably be in a process 6 to 12 months of marketing their business before somebody puts a solid letter of intent on it. So although there's no like guardrails that prevent people from walking away, once you're in this letter of intent sort of piece of the process, you have external factors keeping folks in within reason. Does that make sense?
Yeah, it makes sense. Well, let's talk about funding. Are people buying businesses in cash, or are they getting some kind of funding to back it?
Mark, if you know folks buying businesses in cash, please let me know. I want to talk to them right away. The name of the game is leverage buyout. And so that means leverage, which is debt. There's many ways to do it. You can do it with cash, and that has less risk, right? If you can put $2 million up for a business, you don't have a bank in your stuff, and you can operate that business sort of at your pace. But with that same sort of $2 million, you could potentially put $500,000 down on 4 deals and buy $3 or $4 million companies 4 times. So what do you do that with? How do you do it? For smaller businesses, I'm talking about under $5 million in purchase price. The SBA has a 7A loan program. I won't get into the specifics, but essentially the government will back up to 75 or even 90% of the loan, so that the bank is on the hook for 10%. The bank will make you and the seller put up 10% of the transaction so that they're covered. And it allows banks to take somewhat riskier bets on smaller businesses with first-time buyers because the government's stepping in to backstop the debt. And so you should look at the 7A program through the SBA to understand better how that goes. Most of deals under $5 million, 90+%, are done using SBA loans. And if you're looking for references for loans, places like Live Oak and Lisa Forrest are a great place to look for that.
So I'm sure the banks getting involved, they're going to do their own due diligence. Where do you see problems where the buyer does their due diligence, comes out everything looking good, the bank does theirs, and it doesn't look good, and there's problems? What did the buyer miss that the bank picked up on?
Well, the thing about this is when you're fundraising, that's what it is. So when you go to the bank and say, hey, I want debt, you don't want to kind of go in with disparate data all over the place. And small businesses have pretty messy financials. So the function of sort of your diligence is to take this messy financial sack of stuff and put it into a financial package that a bank's used to looking at, like a quality of earnings or at least a review set of financials. So your diligence provider may catch things that the bank misses. The bank may catch things the diligence person missed. What kind of things are they, Mark? So there are things like a non-physician can't run a physical training business in certain states. So you may have the financials and the interest, but you can't run it. And the bank doesn't want to be loaning to Mark, but Elliott holds the license as mission critical to the business, for instance. Or you may find that the person said they did $1 million in profit on their financials, but they told the IRS they did 100,000 or 1/10 of that on their taxes. And so now there's a reconciliation around how much profit the bank will accept around the business to fund it. What other things come up? So the bank may do a background check on the seller and find out that the person has some stuff that they feel uncomfortable about. And then anybody who's dealt with banks in any capacity, like real estate, knows that there's always about 20 things that can come up, right? You need 3 more months of bank statements or 5 more sort of pieces of analysis around profit per product. And so there's sort of a lot of things you can miss. Let me tell you why the stakes are a bit higher here. Because you're paying 3 to 4 times profit, what that means is the seller has a 3 to 4x incentive to misrepresent them, meaning they don't get a dollar for dollar benefit for fudging the truth. they get a 4x benefit. So $100,000 becomes $400,000. And so even honorable people are put to the test around being honorable at this time. So it's really mission critical. You get diligence right, because if not, you get hit with the 4x stick, right, for any mistake you make.
Are you seeing any instances where the seller will finance part of the transaction or the purchase?
Yes. If you heard a second ago, the typical deal is a SBA 7A loan, and the bank can cover up to 90%. The seller and the buyer have to cover that remaining 10. So in minimum, it's 10% covered by the buyer and the seller. They typically split it half-half. However, in a deal with more risk, let's say it's a professional service business. We both run professional services businesses. If you were to buy one of our businesses, you would need to tie one of us to the business for some period of time to understand the processes, who the clients are, all the rest. So in that case, you may ask the seller for a larger seller note so that the seller is financing a bigger part of the transaction, so that the seller is more invested in the buyer's good outcomes and will help the buyer for a longer period of time, because they have sort of two bites at the apple, one at close and one when they get paid out on their seller financing. Similar to like real estate seller financing, although I've seen seller financing on acquisitions of businesses be as high as 30 or 40%.
And what you were mentioning about the seller, do they also sometimes, and you hear about them staying on as part of like a transition? Does that really happen? Does that really work?
Okay, so those are two different questions. I love that you asked them. Does it happen? Yes. Most times it's written in the purchase agreement. Does it work? Here's how I talk about it, because I like having fun with the work that I do. So let's say you pay a gal $5 million to buy her business, right? And let's just say you're like, oh, I want to be sure, so I'm going to have her hold back 5%. So $250,000 on a $5 million deal, right? And so what you have to sort of think about is, if they're working for you for, say, 6 months and things get really hot 60 days in, and they took home $4.75 million and they went to the Bahamas or to the Alps or to Banff in Canada or South Florida, and it's tough, so this is hard work, are you going to get them on the phone for $250,000 when they took home $4.75 million 60 days ago?
Probably not.
The other thing that happens in terms of leadership, and that's a longer conversation, but you're not going to accept or want to do everything the seller was doing in the business. And so if you leave and still work with the seller ongoing and they're not willing to let go of their baby, you can be in tension with the person who sold the business, who now works for you at the detriment of the business, the cash flows, your return. And so you have to be hopeful that the seller relationship post-close will work out and they will sort of honor and finish their agreement. But as a prudent buyer, you need to be ready for those things to deteriorate and you still be whole.
You mentioned something interesting about, the buyer not necessarily doing everything the seller did when they were in there. And I'm seeing, people looking to buy businesses and it's mixed. Some want to buy passive, some want to actually actively run it. And then there's this area in between where even they may want to be passive, but it's not, unless you're buying a fund or buying Apple stock and you get, you get your reports, that's truly passive. But I think even some people think, buying real estate or buying a business, they can do it passively. And in reality, it doesn't really work like that. Is there a way to really, truly be a passive investor and own and kind of solely own a business?
Yes. So the nerd in me is going to walk us through like different components of risk along the spectrum, right? So you got your public market stuff, you have your real estate stuff, you may have sort of money and sort of business deals with friends of yours. Now, when you get to like buying a company, the least risky way is to find a fund that invests in small businesses and invest in that fund. So like Permanent Capital out of St. Louis, Brent Bashore, Pursuant Capital in Florida, Sam Rosati, Broad Street Partners, and there's others. You can sort of Google them and be an investor in the fund. You get sort of diversified upside, minimize downside. You give up some of the upside for taking some of the downside away across the portfolio, right? You can also say, hey, I'm going to buy a business and I'm going to go find an operator to run it so I'm not in it every day. So I go buy a manufacturing business down the street from me. I find a 30-year veteran of manufacturing to go run it. I pay that person a salary. They work for me. I don't step foot in the business. A little bit more risky, but you're less in the business. And then the more all-in scenario is you go buy a business where you intend to run it. So there are some semi-passive ways to get this done.
Does 2 and 3, 2 where you find the operator, and 3 where you run it yourself, they seem like they would actually be the similar risk with, someone a first time business. I'm sure there's risk with them going and operating, and sure they'll learn probably on the way, but they'll probably make mistakes on the way as well, versus paying someone who has experience in that. Do you see the success rates differ between those two groups at all?
Great question. So this is one of those ones where it all depends, right? So if you hire an expert in the industry who's motivated to run the business, who is compensated appropriately, both salary and bonus, to keep their incentives aligned with yourself, that's honorable, because that's either they're honorable or you're ultra prudent with your accounting controls and systems so you know what's going on. Those deals do very well, right? Because both you and the operator have a huge incentive for things to go well. And if things go poorly, you're both highly incented to sort of roll your sleeves up and get some work done, including hiring a consultant or somebody else to come in and help to make sure your debt payments are getting paid. Now, on the side where you go run it yourself, I've never seen motivation the same as sort of that one butt to kick, one throat to choke. So your business, your loan, the 7A program comes with a personal guarantee. You're running the business. If that business is doing poorly, every ounce of your energy will be exhausted to get it done. And so I think there's sort of pluses and minuses of both scenarios. And I think a lot of the risk mitigation of option 2, where you find a operator, is your trust level with the operator, Mark. Like if I was hiring a person I knew for 10 years that I knew had done 2 companies of this size, very low risk in that. If I'm interviewing for this role, that's a very different situation.
Yeah. So you mentioned, personal guarantees on that SBA loan. So the buyer definitely has a lot of skin in the game. You hear, well, you're buying your home, it's your biggest purchase. Well, for majority of people, that's true.
Sure.
But for someone buying a business, this takes it to a whole nother level. What are like 3 of the biggest mistakes you've seen people do when buying business?
Great question. And I'm going to speak sort of to your audience, Mark, because I think it depends on who the buyer group is. So you guys, seasoned investors, doing a lot of stuff in public markets. So if you think you can do this part-time with hired help and none of your energy and none of your guidance, you're going to miss the boat. Because it's your risk, you need to be involved, right? So whether that means, taking a sabbatical, whether that means, spending some nights and weekend time, you need to be present, available, and sort of focused on the outcome for it to go right. So you can't sort of completely advisor your way out of the work. The second mistake people make is not focusing on primary documents. So we all saw what happened with Theranos out in Silicon Valley a couple months ago, right? Billions of dollars lost from very smart investors who should have known in November that year-to-date financials weren't on pace with what was presented in January, but never checked. Looked at documents that had things on them that weren't verifiable. So in small business, the by and large financial system used is QuickBooks. You should be looking at a file that either has the QuickBooks header in PDF or the QuickBooks header in Excel. If you're looking at taxes, don't allow a broker to copy the tax stuff onto a cute document with their header without a signature and think that's good enough. You need to be going to the primary documents, the bank statements. Don't allow somebody to send you an Excel that says Bank of America at the top and not make sure that came from Bank of America. That's the second biggest mistake. I think the third mistake is sometimes people have not negotiated in what I call free space, right? So when I was in corporate working for like firms like Accenture or Workday, the software company, when I went into negotiations, they were like plus or minus 5 or 10%. You were able to get something 10% less expensive than the person came in with, or you negotiated a 10% better deal on your salary. In private business negotiations, it can be plus or minus 50% or 100%. And so when people are getting into this world for the first time, not recognizing things can be hugely different than average, and they might not even have a good sense on what average or market is, getting in there without recognizing you're going to need advisors to help you understand what is market terms on a purchase agreement. On the nuanced pieces of calculating profit and EBITDA for small businesses, how is it typically done? How do you get had in that transaction? So not having enough experience in some of the mission critical things like negotiations, and that thinking you can sort of get it done, but you're betting a lot bigger. So the thing I tell people all the time as a fourth, if you allow me, is that if your house is your bigger investment and now you're going sort of 10x your house investment, you need to sort of realize you're taking on incremental risks. You need incremental protection. So don't go like 10x your biggest investment without being thoughtful and prudent.
Yeah, makes sense. And that's some great advice. Well, Elliott, we're just about out of time. I want to thank you for being on the show. You gave some great tips on how best to buy a business. How can someone reach out to you, find out more information about Guardian Due Diligence?
Sure. So you can Google me or look me up on LinkedIn, Elliott Holland. That's ELLIOTT, Holland, like the country. My website is Guardian Due Diligence. If you put that into the search bar, even if you misspell it a little bit, I think my SEO is enough to get me to the top. And you can also, for your listeners, the first part of this process when you really get serious is a letter of intent. So if you want to have your letter of intent reviewed and your company valuation reviewed, you can go to offerfromelliott, ELLIOTT.com, and I'll review your letter of intent and your valuation for free.
Great. We'll link to all that in the show notes. So thanks again, Elliott, and thank you everyone for tuning in today.
Thank you, Mark. It's been great.
Thank you for listening to the Agent of Wealth podcast. Click the subscribe button below to be notified when new episodes become available. The information covered represents the views and opinions of the guests and does not necessarily represent the views or opinions of Bautis Financial. The content has been made available for informational and educational purposes only and is not intended to be a substitute for professional financial planning and investment advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investments and financial planning.